something just happened that sent shockwaves through the Bitcoin world. Out of nowhere, several Satoshi-era wallets, dormant for over 14 years, suddenly sprang to life, moving a jaw-dropping 80,000 Bitcoin, worth roughly $9 billion. We're talking about some of the oldest Bitcoin in existence. One whale sent over 40,000 Bitcoin to Galaxy Digital. Another batch, about 6,000 Bitcoin, was transferred to exchanges like Binance and Bybit. These aren't just dust transactions. These are chess moves. And now the entire market's holding its breath. Why now? Why these wallets? And most importantly, what does this mean? Moves like this from legacy wallets are rare. They carry weight, they trigger speculation, and they almost always precede something big. Welcome back to JRNY TV, your no BS guide to what's really happening in crypto right now. Today, we're taking some time to dive into the whale activity, the implications of 14-year dormant wallets waking up, and whether or not this is signaling a coming crash or the start of something much, much bigger. Up next, we're going to be breaking down whale behavior patterns, what they've meant in past cycles, and how the market usually reacts when the giants start moving. Whale behavior and market reaction. Crash or pump? Every time whales move, people panic. But here is the thing. It's not always bearish. Sometimes it's just noise. Other times, it's the start of something massive. When legacy wallets, especially those untouched for over a decade, suddenly light up the blockchain. It shakes confidence, it stirs headlines, and it triggers all kinds of theories. Are they cashing out? Are they reallocating? Or is it part of a deeper strategy? Historically, large dormant wallet movements, they have happened during major inflection points in the market. Back in 2017 and again in 2021, whale activity spiked right before massive volatility, both up and down. In some cases, it's led to profit taking before big corrections. In others, it's been a transfer to custody, not a sell signal at all. That tends to be the nuance that most people miss. But what makes this one unique is the scale and timing. We're not talking about a couple million in dust. This is 9 billion worth of Bitcoin shifting in a narrow window. And that kind of volume, if dumped directly into the market, it would definitely move price. But so far, the market hasn't nuked, which suggests this might be more about positioning and consolidation, not panic selling. This is where on-chain metrics become crucial. We're going to be breaking down those next. But for now, just know, when whales move, it's not always a warning. Sometimes it's a signal of something much bigger that's in the works. Market fear, on-chain metrics, and how this mirrors past cycles. Once the dormant wallets explode back to life, fear usually hits first. But on-chain data is telling a much deeper story. And it's not just panic. In early July, analytics firm CryptoQuant reported a 121% increase in moving old coins compared to last year, with 62,800 Bitcoin aged over 7 years shifting between January and March, versus just 28,000 Bitcoin in Q1 of 2024. That echoes what we saw around the 2019 breakout and again in late 2020 when whales moved stash but didn't zap the market. Instead, they consolidated or they prepped for a new rally. Same with this 14-year activation. About 40,000 Bitcoin moved to Galaxy Digital OTC desks, and others shifted to modern SegWit-compatible wallets, not exchanges. That smells like housekeeping, not panic selling. Yes, exchange inflows spiked about 81,000 Bitcoin in a single day. Woohoo! The highest since February. But crucially, those whales aren't hitting the sell button directly. Instead, they're forging paths that align with rotation, not liquidation. The reason is smaller whale inflows. Less than 100 Bitcoin jumped from 13,000 to 58,000 Bitcoin. But this often signals profit chasing, not full-blown dump mode. And look, Bitcoin is still cruising near all-time highs. Network activity is robust, long-term holders are stacking, and market structure, it remains firm. In fact, institutional inflows, ETF related, now exceed 14.8 billion with a B, with spot ETFs driving over 52 billion in cumulative investment, a sign that this rally is driven by capital, not panic. So do not worry, $9 billion moving around is massive, but signs from on-chain metrics and past cycles, they suggest that this isn't the end of the party. So grab your hat and recognize that this might be just the start of the next act. why institutions aren't worried, and what they're predicting for Bitcoin. While the headlines scream whale dump and retail sentiment wavers, institutions aren't just unbothered, they're thriving. BlackRock's iShares Bitcoin Trust, known as IBIT, now holds over $86 billion in assets, managing more than 700,000 Bitcoin, which is roughly 3.5% of the entire circulating supply. That's not a hedge. That's a massive, full-scale position. And across all spot Bitcoin ETFs, we've now crossed 54.7 billion in total net inflows, with a 12-day streak of continuous buying totaling over $6.6 billion. These numbers don't suggest fear. They, in fact, scream confidence. Institutions, they understand, something the average investor tends to miss. When long dormant wallets move, it doesn't always mean a dump is coming. In most cases, it is about custodial reshuffling, estate planning, or long-term positioning. The majority of the 9 billion in Bitcoin that moved this week, it landed in OTC desks or newer cold wallets, not spot exchanges. That suggests strategic planning, not panic selling. And institutions, they're loving the temporary fear. They're utilizing it as a window to accumulate without the slippage. Big banks and funds are still riding the bullish wave. Standard Chartered, it remains firm on its $35,000 price target for Bitcoin by Q3, backed by ETF demand, global macro uncertainty, and decreasing Bitcoin float on exchanges. Meanwhile, analysts at Bernstein are calling for 150,000 in 2025, leaning on the post-halving supply crunch and persistent institutional inflows as key catalysts. These aren't anonymous influencers that are throwing out moonshots. These are major research desks managing billions. So no, institutions aren't sweating $9 billion in movement. They are studying it. They're watching how the market reacts. And most importantly, they're buying into the volatility because for them, the long game is clear. Bitcoin isn't going away. It's becoming the backbone of modern finance, and they're doing everything that they can to own a piece of it before the next wave hits. Don't fear the whales. Follow the signals. So here's the bottom line. Just because the whales are moving billions around doesn't mean that you should be running for the hills. In fact, history tells us the opposite. These massive transfers usually come right before the next breakout, not after the top. And this time around, the on-chain data, institutional flows, and price action are all pointing in one direction, up. Long-term holders are steady, ETFs are soaking up the supply, and the biggest players in the scene, well, they are still loading their bags, not dumping them. This isn't the start of a collapse. It's the shakeout before the next leg. So if you're watching the market moves, reading the metrics, and ignoring the fear, you are already ahead of the herd. The next phase of this cycle could be the most explosive just yet, but only if you keep your cool when the headlines get loud. Because make no mistake, while the retail panic sells, smart money positions. Thanks for watching JRNY TV. Please don't forget to like, subscribe, and smash that little notification bell so you never miss what's coming next in crypto. As always, stay early, stay informed, and we will catch you in the next one.